The asset allocation problem for insurers is an order of magnitude more difficult than the one which most other investors face. Insurers have a three-dimensional problem to solve rather than the usual two-dimensional risk-return problem. And striking a balance between return, risk, and regulatory capital due to recent uncertainties in regulation and the macroeconomy has never been more difficult. And so Ardea Investment Management, in conjunction with the University of Sydney, has developed a specialised tool exclusively for insurers. It optimises portfolio allocations across a proprietary and purpose-built three-dimensional efficient frontier encompassing Solvency II, market risk, and return. Our tool offers several advantages. It facilitates a comprehensive analysis of capital efficiency across various asset classes. It empowers insurers with the ability to conduct extensive scenario testing, enabling them to fine-tune their investment strategies to suit a wide array of market conditions. It exhibits flexibility and adaptability, easily aligning with different regulatory environments, including potential climate-related capital requirements. In a financial landscape where conventional tools may prove inadequate, our unique capital management tool is expressly crafted to assist CIOs in navigating the intricate and ever-evolving investment environment. So why do we need to model in three dimensions? The solvency capital ratio is designed to estimate the conditional value at risk at a specific confidence level set at 99.5%, equivalent to the 0.5% quantile. However, when we plot the solvency capital ratio against this CVAR value, we can see that there are examples where portfolios with low CVAR may exhibit higher capital charges and vice versa. So there may be cases where the pickup in Sharpe ratio may more than compensate for any given capital charge. And this also means that almost all of the time there is a trade-off between return, market risk, and capital charge. This necessitates a three-dimensional approach to optimizing the asset allocation.
So what does our tool offer? The tool currently includes Solvency II and LAGIC regulatory frameworks, but can configure to any regulatory environment. We can model your portfolio using either holdings or index proxies. The optimization can be performed on asset classes, asset managers, or at the security level. You can also constrain the optimization in any way you like, as well as drill down and explore a variety of risk, return, and capital charge metrics. The tool allows custom modeling, capital market assumptions, and sampling from specific time periods, and the user can test the impact of new regimes and the capital charge configurations in a changing regulatory world, as well as model different economic environments. Now onto some use cases of the tool. One particular use case which is especially interesting is climate change scenario modeling. We recently published a paper in the Global Finance Journal which shows how climate change transition risk is being priced into government bond yields. We published the paper as part of our academic partnership with the University of Technology, Sydney. Using that model and our knowledge of the potential climate change charge that is on the agenda under Solvency II, we modeled a typical insurer's portfolio with and without the charge. What we wanted to do was show insurers that the tool can help them to understand what might happen if they are subject to a new regulatory environment. We can also perform scenario analysis and capital efficiency analysis. Here we model the capital efficiency of various asset classes over the beginning of the COVID period, March 2020 to March 2021. To do this, at the asset class level, we plot return over CVAR against return over the solvency capital ratio. In general, we want both return over risk and return over capital charge to be as high as possible. But sometimes it's not clear if the savings on market risk are outweighing the cost of regulatory capital, and whether the returns are more than compensating for both market risk and regulatory capital. And so what we do here is normalize the comparison using returns. This plot is a really great way to very quickly understand the capital efficiency of any given asset class under different economic scenarios.
Using the tool, you can also easily add portfolio components and adjust the allocation to quickly generate new risk, return, and capital charge results. This is a useful way to quickly perform analysis to compare the impact of new asset managers, asset classes, or the like.